To get back to those GDP numbers and all that they signify for the U.S. economy. We're going to go to an economist to talk about that right now. Russell Price from the Ameriprise Financial. He is a senior economist there. Joins us to talk about GDP numbers, and he stayed with us for a while. I want to thank you first, Russell, for hanging with us during this breaking story we're covering out of Washington and New York simultaneously. Let me ask you about your reaction to this morning's GDP numbers to kind of get back to the economy here. 2%. It was in line with expectations. We did get, though, household purchases at a little bit of a faster pace, a 2.6% gain, which is the best that we've seen in this recovery. Is that the only thing to be optimistic about? Is that the only positive to pull out of this report?
Well, with consumer spending being a little bit better than expected, I think, and the consumer is 70% of the economy, I think that's quite a lot to be optimistic about. If you look at retail sales data over the course of the third quarter, each month showed a pretty solid month-over-month expansion. That compares to in the second quarter when retail sales actually declined on a month-over-month in each of the 3 months. So the consumer is starting to come back to life a little bit, and certainly even the improvement in the stock market and with even bond prices doing well in the third quarter and commodity prices doing well in the third quarter, that contributes a little bit to the wealth effect for the average American. So that should continue to entice consumers to continue to spend as we go into the fourth quarter. So we do think that it was a fairly positive report overall.
What about the Chicago report as well? Because that came in upbeat as well.
Right. The Chicago report was also quite encouraging. It did come in quite better than expected. I think what's been happening in the manufacturing sector is if you look back to the mid-spring when the economy was really starting to gain some momentum, demand fell off then in the month of May amid the European sovereign debt fears. And as demand fell off, manufacturers were unable to reduce their production volumes fast enough. So we had a little bit of an inventory buildup during the summer months. Now that inventory seems to be working down, and manufacturers seem to be responding to the improvements in demand that we've seen, notably the improvements in consumer spending that I mentioned, and also business spending is also doing quite well.
So, Russell, well enough that we don't need QE2 at this point, or is that just a psychological thing that if the Fed doesn't do it, it's just going to kind of blow apart the markets here and really kind of the psychology of the markets?
Right. I think that's very important. Right now, I think the risk to the economy is really that the Fed does not do QE2 or does not do enough QE2 that the market is currently expecting. Because like I said, with asset prices, stocks, bonds, and commodities being higher, that contributes to people's wealth effect as far as their perceived financial situation and what they're going to spend. If the Fed were to come out next Wednesday and say that, economic conditions are doing well enough that we don't feel we need that, we think that would have a negative impact on all those asset prices, and it could reverse the improvement that we have seen and thus offset some of the intended effect that the Fed wants from a QE2 program. So we do think that they are going to come with an announcement on Wednesday that they will indeed do some quantitative easing.
Hey, Russ, we got to run. Listen, thanks so much for breaking that down with us. Russell Price over at Ameriprise Financial. He's a senior economist.